While the West resets, certain emerging markets are set to explode. The 1% have been rotating billions there since last year. The 4 hottest spots revealed. Architects, this is Dr. Ben on Wealth Architect. You already know we skip the recycled advice that keeps most portfolios stuck in the same slow lane for decades. Instead, we break down the exact blueprints the wealthy follow to create real independence. Right now, as we sit here in early 2026, a quiet but massive shift is underway. Capital is leaving the expensive, crowded developed markets and heading into 4 specific emerging economies that are built for the next decade of real expansion. Today, we go long and detailed on exactly why this rotation is happening, which 4 countries the institutions and family offices have chosen, the precise protection layers they put around every position, and the complete step-by-step plan so you can take part at any account size. By the time we finish, you will have every number, every sector driver, every real-world example, and every practical move you need to put this blueprint to work next week. This is not speculation. The inflows already happening in 2026 prove the math is working. If you want your capital to stop moving in perfect lockstep with the S&P 500 while the rest of the world accelerates, stay with me. We are building something that lasts. The capital rotation happening right now, the numbers driving the move. Let's start with the clear data that institutions use when they decide where to place money. Global growth for 2026 is projected at 3.3% according to the IMF January 2026 World Economic Outlook update. Emerging and developing economies are expected to grow just above 4%, while advanced economies manage only about 1.8 to 1.9%. That gap is not small, it is structural, and it is widening. The U.S. equity valuations remain near record highs, with forward earnings growth in the low single digits. Europe faces persistent energy costs and political fragmentation that slow investment decisions. The U.S. dollar has been softening since mid-2025 as the Fed holds rates higher for longer than many other central banks. Now look at the other side. Emerging market ETFs pulled in record inflows in the first quarter of 2026 alone, with more than $35 billion moving in January and February. Private banking reports from Switzerland and Singapore show family offices that once kept 80% of liquid assets in U.S. and European names have reduced that share below 60% and redirected the rest into targeted emerging plays. 3 forces explain why this is happening at scale. First, companies worldwide are finishing the supply chain diversification that started after the disruptions of 2022-2024. New manufacturing bases in these 4 markets are already online and winning contracts that used to go elsewhere. Second, domestic demand inside these economies is no longer a forecast, it is happening now. Rising wages and a growing middle class are driving spending on goods and services that create self-reinforcing growth cycles. Third, policy frameworks in these countries have improved after lessons learned in the previous decade. Primary surpluses, higher foreign exchange reserves, and clearer rules for foreign capital have lowered the political risk premium that used to scare off big money. The result is simple math. Staying fully parked in developed assets now carries an opportunity cost that the 1% refuse to accept. They moved early because the numbers lined up. This section alone should make you pause and ask, if the data is this straightforward, why is my portfolio still 100% in the same places everyone else owns? To make this concrete, consider what happens when you stay fully concentrated in developed markets. Your portfolio moves almost exactly with the S&P 500 or the Euro Stoxx 50. That means when those markets correct 10 or 15%, so does your wealth. By adding exposure to these faster-growing economies, you create a natural offset. The same capital rotation that the 1% executed in late 2025 is the one that delivered double-digit returns for many family offices, while developed indices were flat or down. Let's look at the flow numbers one more time. Bank of America data from January 2026 shows MSCI emerging markets up 11% in the first month alone, with local currency debt funds seeing $1.5 billion in fresh inflows. This is not random money, it is deliberate reallocation from overvalued developed assets into places where valuations are still reasonable and growth is still accelerating. If you are someone who has watched your retirement account crawl along at 7 or 8% annualized for the last decade, while inflation ate away at real returns, this rotation offers a different path. It is not about chasing hot tips, it's about aligning your capital with the actual engines of global growth in 2026 and beyond. The 4 countries receiving the capital, complete country playbooks. The serious money is not spread across every emerging market. It is concentrated in 4 economies whose growth engines complement each other and together create balanced exposure. Let's walk through each one with the latest 2026 numbers and the exact drivers the wealthy are buying. Country number 1, India, consumption and services engine. India is projected to grow between 6.8 and 7.2% in fiscal 2026-27, according to the government's own economic survey and consensus from major banks. That pace is among the highest in the world. The growth is coming from multiple engines at once. Infrastructure capital expenditure is budgeted at 12.2 trillion rupees for the coming year, up from 11.2 trillion the year before. That money is building highways, airports, data centers, and green energy projects that multiply across the economy. The middle class continues to expand by roughly 30 million people annually. That translates into measurable demand for two-wheelers, consumer electronics, financial services, healthcare, and premium goods. Valuations remain reasonable. The Nifty 50 trades at a forward price-to-earnings ratio around 20 times, while many U.S. large-cap tech names sit above 30 times. Earnings growth is expected in the mid-teens for the next 3 years. The allocations the 1% are increasing right now include private banks with clean balance sheets and rising deposits, IT services companies winning global AI and digital transformation contracts, consumer staples and discretionary names that dominate local brands, and renewables plus power generation tied to the country's aggressive green targets. A major U.S. family office increased its India exposure from 4% to 12% of its global equity book in late 2025. They used a mix of ADRs and local mutual funds focused on quality compounders. Their internal note cited structural domestic demand and policy continuity as the 2 deciding factors. That's the kind of thinking behind the rotation. To solve the common problem many investors face of over-reliance on U.S. tech concentration, India offers a true growth story. When you add India exposure, you gain participation in a market that grows faster than the U.S. while trading at lower multiples. That combination is exactly what the 1% look for when they want asymmetric returns without taking on unnecessary risk. Country 2, Vietnam. Manufacturing and export machine. Vietnam delivered 8.02% GDP growth in 2025 and has set a 10% target for 2026. More than 60% of the population is under 30. Urbanization continues at 2.5% per year. The country recorded its first state budget surplus in 2025 and is on track to repeat that in 2026. Foreign direct investment reached a 5-year high of $27.6 billion in 2025 and is accelerating. Major technology and electronics names have announced fresh capacity expansions. Every new trade agreement that helps companies avoid tariffs adds another layer of momentum. The market is still small enough that an MSCI index upgrade could bring tens of billions in passive money over the next 2 years. FTSE Russell is expected to move forward with reclassification in September 2026. The wealthy are positioned in export-oriented manufacturing, domestic consumption plays such as retail and banking, and energy plus infrastructure projects that support the new factories and ports. Valuations on the VN index remain roughly half those in India, and cash flow yields on quality names still sit in the high single digits. This is the market where the 1% are buying the tools that will power the next decade of global supply chains. Many viewers worry about supply chain fragility after recent global disruptions. Vietnam directly addresses that concern by offering a stable, young, and cost-competitive manufacturing base that is already winning market share. Adding this exposure gives you participation in the very companies and sectors that benefit every time another firm diversifies away from concentrated production hubs. Country 3, Indonesia, resources and population scale. Indonesia is targeting 5.4% growth in 2026, with upside potential to 5.6% if priority sectors accelerate. The country has 280 million people, abundant natural resources, and a government that has removed several foreign ownership restrictions that once deterred institutional capital. Commodity prices have stabilized at levels that support government revenue without the old boom-bust swings. Nickel, palm oil, coal, and copper all benefit from global energy transition demand. At the same time, domestic consumption is rising as the middle class grows. Policy reforms under the current administration are opening doors while protecting local champions. The result is a self-reinforcing cycle. Higher revenues fund infrastructure, which lifts domestic growth, which attracts more capital. The 1% treat Indonesia as their Southeast Asia anchor. Allocations go into banking and financial services that ride rising financial inclusion, commodities and mining names that now meet stronger environmental standards, and consumer goods plus retail that serve the expanding urban population. Growth estimates for 2026 sit at 5.3%, with a currency that has strengthened against the dollar over the past 12 months. If you have ever felt exposed to commodity price swings or worried about over-reliance on a single region, Indonesia provides a natural hedge. Its resource base and massive population create built-in demand that persists even when global trade slows. This is the kind of ballast that turns a portfolio from volatile to durable. Country 4, Brazil, policy pivot and commodity hedge. Brazil's 2026 GDP growth is forecast around 2% to 2.2%, but the real opportunity lies in the combination of monetary easing, improving fiscal discipline, and commodity strength. The real has strengthened. Real yields on local government bonds still deliver 6 to 8% after inflation. The central bank has already begun gradual rate cuts, with the policy rate expected to reach around 11.75% by year-end. Fiscal targets aim for a primary balance improvement even as public debt sits near 75% of GDP. Commodities provide a natural buffer against global inflation and dollar weakness. Agriculture, energy, both conventional and renewable, and financials create a diversified base. Political stability is stronger than headlines suggest, and the central bank has earned market credibility. The 1% use Brazil as their yield plus growth sleeve. They hold high-quality banks trading at single-digit multiples, commodity producers with solid balance sheets, and infrastructure concession companies that benefit from ongoing privatization. This market serves as the Latin America anchor inside a broader emerging markets allocation. For viewers who want income alongside growth, Brazil stands out because its real yields still beat developed market alternatives by a wide margin. This solves the problem of low-yielding bonds in the West, while still offering equity upside from commodities and domestic recovery. Protection frameworks the 1% apply to every position. Most retail investors lose money in these markets because they buy the story and skip the safeguards. The wealthy do the opposite. They never put more than 3 to 5% of total portfolio assets into any single country. They hedge currency exposure with local currency instruments instead of leaving everything in dollars. They combine equity positions with private credit opportunities inside these markets that pay double-digit yields and sit higher in the capital structure. They screen only for companies with strong free cash flow generation, low debt levels, and proven management teams. When possible, they bring development banks or multilateral institutions onto the cap table through blended finance structures to lower the effective risk. They rebalance once or twice a year on a schedule decided in advance. They maintain detailed scenario models that test every holding against currency swings, commodity price shocks, and political events. The outcome is participation in the upside with far lower downside volatility than the typical broad emerging market index experiences. That discipline is what turns a temporary allocation into a permanent wealth-building tool. This framework directly solves the biggest fear most people have about emerging markets, the risk of sudden losses. By copying the size limits, hedging tools, and cash flow screens the 1% use, you can capture the growth without the typical roller coaster ride. Your complete 2026 participation plan, any account size. You do not need 9-figure wealth to follow this blueprint. You need a clear plan. Step 1. Decide the overall size of your emerging market sleeve. Most of the family offices I track use 10 to 15% of total investable assets here, split across the 4 countries. Step 2. Select the right vehicles. For India, combine the INDA ETF for broad exposure with individual ADRs of quality names. For Vietnam, use the VN ETF plus any direct holdings your broker allows. Indonesia can be covered with EIDO or IDX ETFs, supplemented by specific holdings. Brazil works well with EWZ or BRZU for equity and local bond ETFs for the yield piece. Step 3. Implement dollar cost averaging across the next 12 months. Put equal amounts to work each month so you never try to catch the exact bottom. Step 4. Set rebalancing rules in advance. Once a year, bring each country back to its target weight. Step 5. Track cash flow metrics instead of just price charts. Every quarter, review the free cash flow yield of your holdings. If it falls below your minimum threshold, you already have a sell discipline. Step 6. Keep records. One simple spreadsheet with entry prices, original rationale, and quarterly updates keeps the entire process professional. If you want the exact one-page allocation template I use in my own portfolio, plus the current watch list of names inside each country, comment EM 2026 below and I will send it to you. This plan solves the practical problem of getting started when you do not have millions to deploy. It shows you exactly how to begin small, scale methodically, and stay disciplined so the allocation becomes a reliable part of your long-term freedom design rather than a one-time gamble. That is the full blueprint, architects. While the West resets, these 4 emerging markets are laying the foundation for the next cycle of genuine wealth creation. The capital that moved early is already positioned. The only question left is whether you will join on your own schedule or keep watching from the sidelines. If this episode gave you even one practical idea you can apply next week, do 3 things right now. Like the video so more people discover it. Subscribe and turn on notifications because new blueprints arrive every week. And drop EM 2026 in the comments for that allocation template. This is Dr. Ben. Go build something that actually lasts. I will see you in the next episode.